The United States is in a very precarious financial position. For years and years, they've been talking about this unsustainable fiscal path. Well, the reality is, we passed that unsustainability a long time ago on this path. I mean, we've arrived at an unsustainable situation. And I think our creditors recognize our inability to service this massive debt. It's over 37 trillion now. And the Trump administration has thrown gasoline on the fire, with the big, beautiful bill. The trajectory of deficits are actually going to accelerate under Trump compared to where they were under Biden, and they already were accelerating. So the debts are really exploding out of control.
Peter Schiff just issued a major warning. He says the U.S. is sliding into stagflation, weak growth, rising inflation, and no way out. The government's reckless spending and tariffs are crushing confidence in the dollar, setting it up for a fall. But Schiff is clear. Gold is the lifeline. As the dollar weakens, gold isn't just a hedge. It's the safe haven that could surge when everything else cracks. His message: time is running out to prepare. So, keep watching the full video now.
I think the bigger picture that investors need to be aware of is that there is a massive shift going on around the world, and it's really two-pronged. From the point of the central bank, it's a movement away from U.S. dollars and into gold. So central banks that had heavily relied on the U.S. dollar as a primary reserve asset, they are divesting of dollars, and instead they are accumulating gold. And so that is, a big change. It also eliminates a big buyer for our treasuries. So the result of that is going to be higher interest rates for Americans as foreigners, foreign central banks are buying fewer treasuries, but also a weaker dollar. And that's going to raise the cost of goods, of imports in particular for Americans, because you're not going to have foreign central banks propping up the dollar. And it also means much higher gold prices because that's what they're buying. So lower treasury prices and higher interest rates and higher gold price. But at the same time, you're seeing a shift among private investors out of U.S. financial markets, so out of U.S. bonds and stock, into their own market. And so that's why you're seeing this huge, outperformance. I mean, for example, I think the S&P is maybe up about 9% year to date, but the Euro-Pacific International Dividend Payers Fund, which is just a fund of foreign stock, is up 36% on the year. And that's a reflection of money going back into foreign markets. And, foreign markets have much lower valuations than U.S. markets. So you get a lot more for your money. You can buy stocks a lot cheaper. The dividend yields are a lot higher, and you don't have the weakening dollar. And so this is a major shift because for the 10, 12 years before that, the U.S. stock market was the strongest. The dollar was strong, and money from all over the world was coming into our market. Now that money is being sucked out, and it's just beginning. So I think this is going to be a long wave that's going to continue for the rest of this decade and into the next, where the U.S. stock market dramatically underperformed the foreign markets, the mirror of what had been happening over the prior decade. So I think it's important that investors recognize this and move as much money as they can into international markets and also into other things that do well with a weak dollar: gold, silver, commodities. Those are in bull markets when the dollar is in a bear market. And I think that's where we are. Yeah, it may not be dollarizing it. It may just look at the nominal performance. I'm not sure. But because the dollar has gone down a lot this year, about 10%. And so that's, really increased the relative returns on the international markets. I don't know if it's in that chart or not, because maybe we may be even higher above that downtrend. A lot of that is the central banks moving out of dollars. The United States is in a very precarious financial position. For years and years, they've been talking about this unsustainable fiscal path. Well, the reality is, we passed that unsustainability a long time ago on this path. I mean, we've arrived at an unsustainable situation. And I think our creditors recognize our inability to service this, massive debt. It's over 37 trillion now. And the Trump administration has thrown gasoline on the fire, with the big, beautiful bill. The trajectory of deficits are actually going to accelerate under Trump compared to where they were under Biden, and they already were accelerating. So the debts are really exploding out of control. The tariff revenue, which again is just a tax on American consumers and American businesses, the tariff revenue is not going to be big enough to offset the, what the government is losing from the big, beautiful bill. So the deficits are going to get worse even despite the mitigation from the tariffs. But meanwhile, the tariffs are harming American industry. They are making American industry a lot less competitive, and they are causing a lot of our trading partners to look for ways, to avoid the U.S. And trade more with themselves. So it's more of an isolationist approach that's going to harm the U.S. economy. So it's we're making the situation worse for ourselves. So that's also one of the reasons that capital is leaving the U.S. because tariffs are making America less competitive. So why do you want to invest in U.S. companies that have to deal with all these tariffs when you can invest in foreign companies that don't? So we've really shot ourselves, maybe not even in the foot, like in the stomach or maybe the head, but the country's in a lot of trouble, and our creditors know that. So they don't want to loan us more money. And they know that, the dollar is going to fall. We're going to inflate away these liabilities. The likelihood is zero because, politicians have been promising that we'd grow our way out of the deficit since the deficit was, just a couple of trillion, and maybe even earlier than that. I just, don't recall. But ever since I can remember, going back to the 1980s, politicians kept saying we're going to grow our way out of the deficit, and we've never done it. What's grown is the deficit. It's gotten bigger and bigger and bigger. No matter how much we grow, the debt grows even faster, and nothing has changed. In fact, the economy is very weak right now. The jobs market is very weak. The only thing that's strong is inflation, and it's going to get stronger. So no, I mean, we don't have the economic growth necessary to grow our way out of this. We're just going to grow into an even bigger problem because we are ignoring it. And it's not even just ignoring it. Again, the government continues to increase spending and cut taxes. So that they have to do the opposite. If you want to get rid of the deficits, you either need to cut government spending, increase taxes, or a combination of both. Instead, we're doing the opposite of both. The government, most recent bill, increases spending and decreases tax. So we took a bad problem and made it work. Well, yeah, you remember before the last rate cut a year ago, I was forecasting that if the Fed cut rates, that long-term interest rates would go up. That was what I was predicting. And that's exactly what happened. And I think the same thing will happen again. I think if the Fed does cut rates in September, the yields on the longer bonds will head in the opposite direction. And that's because the Fed is too easy. In fact, if you look at the inflation numbers that we have now, they argue for higher interest rates. Interest rates are too low right now. In fact, I've been saying the whole time that the Fed prematurely stopped hiking, that it hiked too soon. I mean, it stopped hiking and it cut prematurely. And so inflation is accelerating and the problem is getting worse. And instead of hiking rates, the Fed is discussing when to cut them. And so if they actually do cut them, that's a signal that inflation is going to be allowed to run out of control. And that is going to damage the longer end of the bond market. That makes longer term U.S. obligations even less appealing because inflation will erode away more of their value. So the Fed's going to lower short-term rates, but the market will increase long-term rates. And that will include mortgage rates.
If Peter Schiff is right, the dollar's best days are behind it, and gold's moment is just beginning. Thanks for watching. If you want to stay ahead of what's coming, don't forget to like this video, subscribe, and hit the bell so you never miss an update.